everybody. This is Toni Turner, and welcome to the Market Now as of Friday, August 19th at about 11:30 a.m. Eastern. I hope you all are having a wonderful summer. However, Wall Street's main indexes opened lower today after the U.S. Federal Reserve officials said the central bank needs to keep raising interest rates to rein in inflation, oh boy, dragging down mega-cap growth stocks and technology stocks, and in fact, every index in the market just about. Now let's look at three charts that could give us some insight into the week to come. Okay, our first chart today, as usual, is a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our benchmark S&P 500 index. And as I put in Twitter today, the reason we follow the S&P 500 as traders is because we always want a top-down view to kind of see where our stocks will go, or at least get an idea of where they might go. And in a bull market, 3 out of 5 stocks will follow the S&P 500 higher. When the market turns down, 4 out of 5 stocks will follow the S&P 500 lower. So it is somewhat of a guide to us. Now, when I captured this chart today, the SPY was trading at $421.96. That's about $42.19 on the S&P 500 itself. Now today the SPY is trading at about 12% below the SPY's last all-time, look left over here please with me, the last all-time closing high on January 3rd at $477.71. So we're now just about 12% below those all-time highs. We're in a better place, hoping we stay there, than certainly we were in June. Now, we know that the market started down, traded lower, bounced back up here in March, then fell pretty dramatically down to our June lows down here at 362. And that's our line in the sand here, 362 on the S&P SPDR. That's where we're kind of like, don't go below that, please. After coming down to that 362, it rallied back up here to 393. It tried to get through this falling 20-day moving average, the red line. It tried to get through this red line, but these moving averages, and the longer they are, the more powerful they are. These moving averages can act as price resistance very effectively when they want to. So the SPY, after that June fall, tried to move back up, got to 393. Started to fall down and retest part of that move up, that prior move up, managed to rally again and actually close above the 20-day moving average, then came back down here to a higher low, at least at 471. We like higher lows, as I told you. That means that buyers are coming in, they're not letting price go down and retest where it used to be, in this case 362. So at 371, buyers said, all right, we're in, and the SPY climbed above the 20-day moving average, the green line, the 50-day moving average, and it headed back up to this 417. See that prior consolidation area here? That could be a pretty tough resistance point, but the SPY did well, and it rallied back up over 417, very nice, made a nice move up, and now we're all scratching our heads and saying, wait a minute, if the Fed's raising interest rate, why is the S&P starting higher? Well, it's thinking the Wall Street and the Fed right now are kind of in a kind of slapping each other around a little bit. We're not sure who's going to win here. We do know inflation is climbing. There's no kidding around about that. If you go to buy anything, you know that. But in the meantime, the SPY moved up to the 200-day moving average, and we talked about that last week. That's a pretty tough dude when it wants to be, especially when it's falling lower. So the SPY earlier this week came up, touched the SPY at $431, and then said, I give up. And it rolled over again to where it is today at 421.96. So if it continues to fall from here, if it does, and there's no way of knowing, but if it does, then we're back down to support here at the 20-day moving average that's coming in at $414 and change, call it 415. There's potential support there. Potential support here at the 406 to 417 range in here. There's more potential support there. And on down, of course, to, as I said, the 20-day we just talked about, and the 50-day moving average. That can be pretty good support if it's needed. Right now it's coming in at 395. We can call it, if price continues to come down, it may come down to this area. We just don't know. Last Friday we noted, if you look down here with me at the 14-day RSI, we noted that price had become overbought last week, and so that's a little bit of the reason here. Whenever this line comes up over the 70 line on the 14-day RSI, we know price is overbought, and that usually means there will be somewhat of a pullback as people take profits. That's a normal thing to happen. And at least in the short term right now, that is what's happening. So in the coming week, I'm going to watch the SPY in the market with a lot of patience, which isn't normally my strong suit, but it could turn into a bumpy ride here for a little bit. So sometimes it's better to stand on the sidelines. I've learned that the hard way over the years, and I've become pretty darn good at it. So I will watch this market with patience coming into the next week. I don't have to jump into anything. I can just watch, and I hope you can too. Our next chart here today is a daily chart of the Invesco QQQ, symbol QQQ. As you all know, this is the exchange-traded fund that closely watches and follows our NASDAQ 100 index, of course, that has the major momentum stocks in it that do tend to lead the market around as well, like Apple, Amazon, Microsoft, Tesla, Intel, that whole group. Now, today when I captured this chart, the QQQ was trading at $322.85. And it is trading now at 19% below its all-time closing high. You can't see it on this chart, but it was back in November 19th at $403. So we're back. I mean, when you're in a bear market, it's 20% or more below its all-time high. And right now we're just kind of hanging on, white-knuckling the 19% number. Below its all-time closing high. So bear market territory is 20% or below. So we know that even from the first of the year, we know the Qs fell pretty dramatically, rallied in March with everybody else, then came on down, dove pretty precipitously, gradually moved down here to its June 16th lows everybody had. This one was at 269. It rallied up here to 294 above the 20-day moving average, but like the SPY couldn't do it, and then fell back down to these lows, back down to 276, then made a higher low, and we're saying, good, there's a higher low. Here's the next little higher low here. And then started back up into this very nice uptrend, although not quite as strong as the SPYs, if you will note, but it did make higher lows and higher highs, did go back above the 20 and the 50-day moving average. It looked pretty nice, but I kept trying to kind of wonder about it. Now, it could not, the QQQ could not get up to its 200-day moving average. The SPY did, the QQQ could not. So it got up, the 200-day is at $341, and the Qs got up just short of that. So it now is, it got like a little over 330, but now is back down again to today, where it is now again at $322.85. It is managing to be above its 20-day moving average, which is coming in at 319, call it 320 if you want. It does if it falls, so it could have some support there. It could have some support in this range. And where are we at here? This would be at about 306, somewhere like that, 307, 308. It does have some support there, potentially price support. We've got the 50-day moving average coming in at $300, 301. So that range, that's quite a bit of price support and moving average support right there. So plenty of support, as we did say. It was the Qs were becoming overbought last week as well. So again, back here, am I going to jump into a bunch of tech stocks next week? Probably not. I'd like to see which way this market goes. It could be choppy. And remember, too, that as traders, our main responsibility is to protect our capital at all times. So I'm willing to sit and watch at least for a few days. Now on to our final chart. If you do want to, if you insist on being in the market, I did find the Healthcare Select Sector Spider symbol XLV ETF to talk about. This is the daily chart of the XLV is the symbol. It has 64 holdings. The top components are United Health, Johnson & Johnson, Pfizer, Lilly, AbbVie, that whole group. Now, we do have a lot of stocks and ETFs still overbought in the short term. They've been starting down the last couple of days a little bit, but they're still overbought. In going through the market, I looked at the XLV here. If you want to be in the market, you really, really want to be in it, even if it's choppy. Healthcare is a non-cyclical sector that in volatile markets is usually considered to be a safe haven. After all, we all need our medications, right? So it is considered to be a safe haven. Now, please do know if a market falls hard, healthcare will fall too. We cannot delude ourselves about that. However, if the market just chops around, sometimes healthcare can be a good place to be. Now, it made its all-time high this year in April at $143.42. Then it dove. Look at this little head and shoulders here. Pretty cool. We can bring that down there. Excuse me, there's a shoulder. There's a shoulder. There's the gap when it broke down. There's the gap when it broke below the neckline. Then it came all the way down here, back up to about 134. Note how it came back up. It did manage to get across its 200-day moving average, bumped its head on the 50-day moving average. Then the XLV fell down here. It dove pretty dramatically down to support at about one support low at excuse me, I'm up here now. Hold on, I'm getting there. It did fall down to 125. Then it rallied back up, back through the 20, the 200-day, the 50-day, hit its head on the 50-day, then fell down to the June low at $118.75. Now, if you stand back a little bit with me, sit back in your chair and look, now we see a big inverse head and shoulders. Now, while head and shoulders can be top, and we can make that the shoulder or that the shoulder, it's our crayons. While you can see this top reversal pattern here is a small head and shoulders, now we've got a big dude going on here, potential head and shoulders. And of course, we say when price crosses over the 200, in this case, the 200-day moving average is drawing the neckline for this particular head and shoulders. Pretty nice of it. We can use this as a shoulder here. Excuse me, I'm not drawing this very well. Inverse head and shoulders is positive. Now we can see healthcare in the last month has been consolidating. It's not sure whether to go up with the market or down with the market. It definitely has rallied off June lows. So I like this pattern. I don't love the market right now, but I do like this pattern. But I want to make it I'm going to make this a low risk trade because as usual, I'm in no mood to lose money right now. Right now, it's the XLV is trading at $132.85. It is sitting atop its 200-day moving average and its 20-day moving average, with just below its 50-day moving average. So it's managed to stay atop all of those. That's a good thing. So if in the coming week the market behaves reasonably well, and if the XLV can stay above $131, I may buy a small position of the XLV and in my trading portfolio. Now, if and when it can rise above and close above 134.50, I will add to my position. Now, my initial stop is going to be placed at $130. And yes, I'm well aware that's a tight stop, but again, I'm not in the mood. If you want to lower it a little bit more, that's fine too, but I'm going to keep it pretty tight here for my positions. So again, if it goes over 134.50, I may add to the position if it starts moving up, especially with this head and shoulders pattern. It can be pretty strong when it works out. So keep an eye on the XLV in the coming week. And finally, please know that this is, while the market's acting like this, a great time to invest in yourself and learn. And as I like to say, make your circle bigger. Take a few minutes to check out my online training programs and see how you can become a better trader. These programs include our flagship training, 7 Steps to Successful Trading, awesome product, how to swing trade successfully, how to trade the trend to profits, of course, which is going to be important right now when this market starts up for good. Great for beginners, how to read charts, another good one, a short one, 3 winning setups, and how to bottom fish like a pro, also very good for right now. Now, these programs are low priced, they are timeless, and they can help you increase your gains quickly and easily. To see all of my online training programs, simply go to the link on this screen, or easier yet, just click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.